You're listening to the Best Advice Podcast, guys. If you haven't already, give us a 5-star review and help spread the word. And if you have a question for the guys, email a voice recording to podcast@bestadvicepodcastguys.com. That's podcast@bestadvicepodcastguys.com. Today's episode is brought to you by Security Financial Management. If you're ready to level up your financial game, SFM offers a free initial consultation after each episode. Just send an email to podcast@bestadvicepodcastguys.com with the subject line complimentary consultation to book yours today.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lovaglio, here as always with Austin Fatz Jacks, Mitchell Walk, and Dave Allen. Gentlemen, what's crackalacking?
It's showtime.
It's a busy week. Dave, what do you think about this?
Well, the question of the day was basically volatility. And, living in our world, some people have gotten very used to it. And I always kind of relate it to when, the soldiers are in the field and you see them playing cards and the bombs are going around them. They got used to it. They don't care anymore. Well, we didn't get a bunch of phone calls. We got a couple. There's always that one or two people that are going to call, and they're not freaking out, but they just want to understand. So we're not seeing a systemic, is that the word? A systemic problem here.
Great vocab.
We had a big tech run-up, a massive tech run-up over the last year or so. That can't keep straight up. There's no doubt about it. And then when you have a little bit of bad news, or good news, bad news is good news is bad news. I'm not sure what you switch anymore. Now, I guess bad news is bad news.
Finally, we've heard about it, that we wanted bad news so the Fed would lower interest rates. But now we got to the point where bad news really is bad news. They were hoping for bad news.
And is it really bad news? Okay, jobs were down a little bit. Jobs are still, but the market's a funny thing. So anyway, recent volatility had to do with everything. You had such a run up in tech. It cannot keep that pace. I mean, what NVIDIA? 300% over the last year? 300%? But it has to go back. Nothing that goes up like that can continue that. I look at it as an opportunity now when these changes are happening. Okay, tech's got to breathe. It's going to come back. It is not done by any means. The word AI is real. I think it's a shift that's happened. We saw what happened when the couple weeks ago, small cap ran up 12%, and that's been laying like a sleeping dog for a long time.
And that's you've heard about, to your point, they've talked about it over the past few weeks, is the rotation.
Yeah.
They rotated out of the big, heavy tech stocks that were just off the charts. And to your point, small caps were moving along at, again, we sit here and say, yeah, they're moving along at only 5 or 6%. We used to say 7% for the whole year is great. And yeah, they're only up 6%, 7% in some cases for 6 months. That should be normal. So we've rotated back to those small caps, but now things are coming back again. It's just moving all over.
Right. But kind of to add to that, technology stocks had they were very frothy. The price earnings ratios were way off the chart. Now you got the other sector, all the other sectors, the majority of stocks, other than those 7 or that tech sector, they're still very fairly priced. Don't you think, Austin?
Yeah, absolutely. But it's still, when the market goes down, NASDAQ down like 11% in a month or something like that, emotionally for investors, it's still a little bit jarring.
Yeah.
So you understand that. And it's, how do we help people keep those emotions in check, right? There's a lot of studies that are out. I'm looking at a Wells Fargo one that, over a 30-year period of time from like February 1994 to January of 2024, it's a little bit dated, but not still relevant, is if you miss the 10 best trading days in the S&P 500 over that 30-year period, it accounts for something like 2.75% annually that you miss out on. The problem is, some of those best trading days are surrounded by some of those worst trading days. So this period of volatility. Now it's, how do you manage those emotions when you're in the thick of it? Is take a step back and look like, okay, during volatile markets, that's when we see a lot of these best and worst days. It's just being able to stomach it. You have to kind of, look at that broader perspective and
people
say,
have gotten better at
this
it,
too
though.
shall pass. Yeah, people have gotten better at it.
Because they've seen it and they've seen it come back. Think about COVID March. March of 20. I mean, that
dropped about 40% in one day.
And then ended up 18%?
Yeah, for the year finished up 18, which means it probably had to be up somewhere between 60 and 70 on the last 7 or 8 months.
Crazy.
Just to get that, make up for that 40% difference.
Yeah.
Yeah, Austin, to your point, missing those days is very critical. I mean, it's very, very critical. So what do we do? What we do actually, it's security financial management. And what your advisor should be doing is, we know things go up and down. People always like to see the ups. They don't realize the downs. But what we try to do is, you really got to look at their risk tolerance. Find out, how much longer are they going to work? Are they retired? What is their long time horizon? Because these storms go up and down. It's normal in the market. Things, as your point, Dave, don't go straight up. They go up, they go down. But you've got to see what really works for that person. Everybody is an individual. And that's what we actually do here, is we work with everybody to find out how much risk can they take? Right.
And, Mitch, in the big picture, really the people that should not worry are the long-term investors. Not short-term volatility. What's that word?
Marketility.
Marketility. That's market volatility.
Market volatility combined. He's cutting it down time-wise.
Yeah, that's right. We got to look. So marketility. So market volatility levels out over the long term. In the short term, it can be unnerving if you're a short-term investor trying to make long-term money, that's where you can go wrong. But if you have the long-term, there's going to be periods of times. I mean, there's a period in the 70s where it was just, the 70s was extremely flat. But, then it decides to take off, and then the long-term rate of return all averages out. But there's periods of time where you feel like you're not feeling like it's down, but then all at once, getting uninvested, then you're going to miss it. That, like you said, the best days in trading market are when you don't expect them.
Exactly. And this week was a very, very good week as well to look at it. So far, it's not over yet, but, we had the big drop on Monday, and then it came back very nicely on Tuesday. Yesterday, we had a good upstart, and then it dropped towards the end. And here we are, on Thursday, the 8th of August, and the market had a good start. We don't know what it's going to end like at 4:00, but the job numbers came out. They were in line with what everybody expected. And all it took was one job number. There was no earnings reports this morning. There was no other information.
So jobs on Monday messed it up. Jobs on Thursday
made the market go back up.
Okay.
And that's a short time frame, right? Yeah. But when you stretch it out, those big, you
don't become a day trader, right? So the market goes down and people want to be day traders all of a sudden, instead of sticking to that goal that you guys discussed 10 years ago.
And you can't time the market. I mean, a lot of people just try to time it. You can't time the market. You've got to come up with your plan and have your advisor watch it and work with you on it, because if you try to time it, you're going to make mistakes. Everybody's going to make mistakes.
If it dips, that's when you buy.
Right. It is a buying opportunity.
Don't get confused and get concerned. Just buy if you can. Otherwise, but don't make those dramatic moves. We find that's the worst thing you can
Worst time to do it.
But, this hasn't been prolonged, guys. We had one day, maybe a couple days in a row. And we did have a little bit of a down, but the big day was Monday. But look, it's evening out, and phone calls have stopped, and hopefully the world gets back again, and it will.
I feel like it's kind of like traffic. When you're like driving, there's a wreck, everyone just stops.
Everybody's looking.
Yeah. And everyone just kind of slows down.
I use that all the time.
And actually,
then it goes away and everyone keeps driving.
And then you drive by and you see it's just a little rabbit on the side of the road.
Just wanted to look.
Right.
Little tiny rabbit.
And to your point about these ups and downs.
Rabbits are nice.
What's up, Dad?
When we took the big drop on.
They're soft.
He's dead. He's dead now.
He's dead now.
Yeah.
He died.
I hate that rabbit.
So on Monday, the Japan Nikkei 225 dropped 12%, which caused our markets to go down. And then the next day, the Nikkei came back 10.23%, according to CNBC. So you can see how quickly things fell and how quickly things turned around and came right back.
That's
so we've
really
got to watch that.
There's a lot of quality out there. And maybe those big techs are breathing a little bit. They're not done, as we said.
No.
But the broad market is really, we've had these portfolios that, have large cap, mid cap, small cap, and you're like wondering, okay, when is my value stocks going to start moving? And those are the Coca-Colas and the Johnson & Johnsons and the Procter & Gamble. Exxon's, that's the value side of it. When are they going to have their turn? And they do. And they're most of the market. You know, it's kind of like these 7 bullies have been running the whole market. Now it's their turn to take a seat and let the rest of the people run.
Yeah. And yeah, you're right about that. And to your point, value may start to pick up as interest rates come down. Value gives off nice dividends, and that may be the next sector to watch.
And, you know, on the point of 2022, when markets were way down, tech was down, 30 to 40.
The NASDAQ was down, I think, 33%.
Yeah, S&P down 18 or so. The true value stocks, like a value manager that we use, was down 2%. So they didn't run back in 23 real hard, but they sure defended.
And that can help, you know, mitigate some of that volatility by having exposure.
Should be part of your portfolio.
Yeah.
And there are managed volatility funds, managers out there, and that helps. They lean, to your point, Dave, they lean towards the value side. Right. So those lower volatility managers are worth taking a look at because they help balance the crazy tech stocks that just go way up, and
everybody
then
wants them when they're exciting,
down.
but they don't like them when they go down. They're all really fun to go up, but they're not that fun when they go down.
We only count our wins here.
Yeah, we only want the ups. We want no down.
No down.
I don't count my losses. I count my wins. Let's get some positive energy today with the segment. Give me something good.
Hey, give me something good.
So did you guys know how fast you eat your food actually determines your metabolism? Right? So it's like research is strongly showing that people who eat slower are 4 times more likely of developing metabolic syndromes than people that eat a little faster.
So is it better to eat fast or slow?
It's slow. So it's saying if you don't want to change what you're eating, if you just sit down and eat it slower, your metabolism is going to be 4 times quicker than if you just shove it right down.
That's why we go to lunch all the time. I'm like 15 minutes later than him. He's
down low.
Frank and Dave.
You can't help
Keith,
it.
you're fast.
Yeah.
Yeah. My son Mitch eats like a Hoover vacuum cleaner. That's for you, Mitch. If you're listening. Yeah. So in general, I think we're pretty much done here. But I wanted to, as we always say at the end of each show, is that if you're a listener out there and you want our opinion, you want a no-cost consultation, call our firm. I think down below here, you'll see our link. Reach out to us. We'll schedule an initial consultation either by phone, by Zoom, or in person, whatever works for you. We're happy to share what we have. And if you're interested in that, either connect with us or give us a call. We're happy to have a no-cost consultation with you here at Security Financial Management.
Remember, folks, the secret to wealth is not what you earn. It's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed. If you have a question for the guys, email podcast@bestadvicepodcastguys.com.